So yeah. So over to you guys. So what would you like me to cover?
First of all, what is the basic concept?
Okay. And okay.
How can we actually use this concept in Indian market?
Use the concept of what? Algorithmic trading.
Trading or what we call it
Quant trading. As a retail or as a
these are like most of us and this how it can be
institutional client trading. Okay.
For retail clients also.
Okay. Anything else?
What are different between simple strategies that are locally used and the algo strategies? I mean, what exactly are the different executives to algos and to simple management strategies?
Okay. I'll also touch upon it. I'm assuming that you would like to know that more about that. Okay.
I have one more question. Is backtesting possible without any software or something like that?
Okay. I'll just write backtesting of quant strategy. That covers, right?
What are the parameters you look forward by formulating an algo?
Anything on the platform side that you would like to know more about?
Also the regulatory part.
Okay. For algo regulation. Okay. Cool. So we have decent one. So want to know more about basic concepts of algorithmic trading, background required for algorithmic trading, for being an algorithmic trader, I think that's what. Okay.
If someone is not from the IT background, can he really write those algos or we have to pursue a different course or something like that?
Okay. That will be covered, I think, in this. How can we? Oh, sorry, background required for. So, and conventional versus algorithmic trading strategy, backtesting, parameters of algorithmic trading strategy, platform, this is technology, regulatory framework. Okay. Right? Okay, cool. So how will we go about this is that let's go right from the scratch, as in when you want to start an algorithmic trading desk, how would you go about it? Right. So algorithmic trading, it's a primary mix of algo trading. It's a primarily mix of two things. Pardon the handwriting. It is not visible, so just let me know. Okay. It's one part is the technology. That is a technology setup. Second part is your strategy. So strategy building, strategy creation. Third part is your network. So it will have both hardware as well as network and software. Hardware, software, and network. Network, I mean the lease lines and everything that you will require. Right. Software would be typically the algorithmic trading platform that you need. Platform and the databases right? Okay. In the strategy, it's typically it could be for either for execution strategy or for making money. So it can be alpha trading strategies, or it can be pair trading, or it can be any different strategy, arbitrage or derivatives market making. Right? So I'll just take trading strategy. Okay. So let's go one by one. So so just a brief background about algorithmic trading in India. So, and before that, algorithmic trading itself. So algorithmic trading is nothing, it's a mode of execution. So where there is no human intervention while the trade is going on, and the complete trade is done by the machine, which is programmed to do so. So it can be trading anything, any asset class, but you are connected to the exchange, you are getting data from it, you are processing that data, your strategy is generating order from that, and you are sending it orders to the exchange, right? So that's the typical process that will happen. And for that, you will need, obviously, it's a quite a capital intensive thing. You will need a lot of technology infrastructure. If you want to do algorithmic trading, it's not like that you will just connect your broker and you can send orders. You will need, if you want to be successful, then you will have to considerably do a lot of expenses and expenditure you have to do on the infrastructure side. Okay. Then platform. So platform, or I'll just show you what a typical algorithmic trading platform looks like. Any algorithmic trading platform, it will have three key components. One is your market data server. So if you want to connect to the exchange, if you want to listen to the data, so exchange will be sending the data in some format. You'll need a lead line which will connect to the exchange. Okay, you are connected to the exchange. Now it is sending it in its own proprietary language. So you need to convert that into a language which your machine can understand, right? So what you need for that is a market data adapter. We call that adapter. It's a simple program, not very simple, but yeah, it's simply a program which converts the language of the what exchange is sending the format as to the format which you can understand. Okay, your machine can understand. So here is the exchange, the NSE. It is sending, you are connected to it via lease line, and it is sending you market data. Your market data adapter is converting it, and it is providing it to your machine. Okay. Now you have a CEP, which is complex event processing engine. So all your strategies and all your everything, whatever you want to do, as in you want to say that okay, a moving average simple moving average strategy in which you would like to buy wherever there is a moving average crossover between 20 candles and 50 candles. So whenever 20 is crossing 50 from down, so you buy, and vice versa is sell. Right. So you have to write that logic. You have to code that, program that. So that you will be doing in the CEP. So most of the algorithmic trading platforms, key thing would be this, where how you can program your strategy, how you can implement it. Right. So here all your strategy code and everything will help. Right. And this will generate orders, so which will be sent to a OMS, order management server, or order routing system. So this will be then sending the orders to the exchange. Again, it will have to convert it into a language which exchange understands. So again, there is a adapter which will be sitting here, and it will send the data to the exchange. Right? So that's the typical cycle. In this part, you have the exchange here. Then you have here's the exchange. You're getting the market data. There needs to be a connection between you and exchange for this. Then it's your own infrastructure. Then again exchange, where you again need infrastructure to get connected to the exchange. Okay. So this is the typical basic diagram of an algorithmic trading system. Okay. Okay. This is clear, right? Anything? Yeah. Complex event processing engine. So this is basically you're getting data. right? If you are like we took the example of moving average crossover strategy. So for that you will need to build candles first thing. So for that you will need data, right? So that data is there. Second thing is that you'll keep on updating and you need to check whether it has crossed. Did it cross in the last candle? If it did, then it will say that okay, I want to, if it is a buy signal, I want to buy this many shares. So yeah, you can say that moving at this is the order that I want to execute. This is a buy order which I would like to buy for say 1,000 shares of Reliance, and I would like to buy at this price, or I would like to buy at market, whichever way, right? So that part would be done by the CEP. It will keep on evaluating that, and then you code your strategy here. Right. And then we will have this, it will be sending your order that you prepared to this OMS. And yeah, and that will be sending to the exchange. It will just convert that data packet into the proprietary language of the exchange. Right? Order management system. So whatever it can throw up, you can have a lot of users who are sending orders, right? So all those orders have to be converted into something which exchange will understand. Right. So that part is done by the OMS. Okay. And it will also keep on tracking the log, order info that you need to keep with yourself for compliance and various stuff. So all that part is done in the OMS. Right. Yeah, there would be two different adapters. One would be market data and second would be for order management. Okay. Now going slightly deeper into it. So when you want to get the market data in India, like SEBI allowed algorithmic trading to learn it. Before that, it was not allowed. There are multiple ways in which you can connect to the exchange. So one way is to connect using the internet-based trading. They call it IBT. Another way is to use VSAT, so that's satellite all these things. So these are two old modes which are there for quite some time. Then came the lease lines, in which you connect using the dedicated lease line. So algorithmic trading is only allowed using lease lines in India. So if you want to do algo, if you want to do automated trading, so that would be a necessity that you are connected to the exchange using the lease line. You can have a lease line from anywhere to anywhere, right? You can have a lease line from here to Kashmir or to Chennai or wherever. No, people do go for it. A lot of people who go for it. So there are different ways. You can also go for co-location, which will visit after some time. But you will need a lease line. That's the fact. Vary. It can vary from probably, assuming that you're already a member of the exchange, it can vary from 550 lakhs to probably 2.5 crores. It depends on what kind of scale and what kind of setup you're looking for. Right? So first thing is that getting the market data. So I'll assume that we are trading to trading destination is NSE for the time being. Okay. So for NSE, how you can get market data is there are different kind of lease lines which they provide. I'm just going slightly technical side. If you want to skip this, we can go more on the strategy side, or we can do that. So there are different kind of lease lines which exchange provides. You have A2 line which can be used for both listening to the market data as well as sending the orders. Right. So this would be a 40 message line. So you can send up to 40 orders per second. Okay. So this is something which you would not like to go for in case you want to do a lot of high frequency trading and high fund algorithms. So second would be your D1, D2 line. So in that you will have messages up to 100 per second, and then T1 line, T1, T2 scenarios in which you will have up to 200. Okay. Now the catch is that if you have these two lease lines in that case you will not be able to get market data on these lines. You can only send orders using these lines. So you'll need a separate market data. So either you can use this. This provides the broadcast data. So broadcast data would be the data which is a snapshot of it sends few snapshots, 3 snapshots, 5 snapshots per second. So it will not give you the complete picture of whatever is happening in the exchange. It will just give you a snapshot that okay, at this point in time, this is the situation, this is the order book, this is the these are the traded shares, this is the whatever data. This another way is that you get a T1 line which is dedicated for tick by tick market data. So that contains the complete information. So you will get to know whatever tick, if anything changes, it will send you a packet, right? So it will send you that information. So that data you will have. So it will have 100%. This you can probably say this might have 70% or something in terms of the number of trades or number of the total volume that will be captured, right? So so for this you will have you will need to have separate line. This you can have for both common if you. So this is typical connectivity that you have for the for NSE as such, and just if you want to know about the protocol, this comes on the broadcast will come on UDP protocol, and this comes on a TCP/IP protocol. If you any one of you have a IT background, if you want to know. So this will T1 segment will require a login password. This you can for A2 you can just broadcast it. You can just listen on the your LAN. So if it comes to if it gets connected to your network, so on that particular network it will be available on the machine. So it will just dump. So there will be a dump broadcast which will be bombarded from the exchange to your system. Okay. Yeah. Q9 is? Yeah. See, the thing is that you'll have to optimize between your technology, your cost, and your performance, right? So if you want to just go for performance, then definitely T1 would be required because you will be getting the complete information. And in fact, to add on that, you can have depth till whatever limit you want. Delay time, latency I'll just cover after this. So, but for T1, what will happen is that in a typical broadcast data, you'll just receive top 5 bid and ask, right? So bids are top 5, ask top 5, that you'll have. But in tick by tick, you can create depth as much as you want, 20, 50, whatever. So because you have every information what is happening in the exchange, your information is not limited, right? But obviously handling that is also a challenge. So what happens is that because if you are typically going for the complete thing, F&O, if you are going for F&O, okay, and you're listening for every instrument, so there are about almost 25,000 instruments which are there. If you incorporate all the options, all the expiries, into 12,000 ticks every second. Okay, so that is huge data. So so that it might be difficult to manage that. So what you can also do it, what exchange also provides you is, which is a more recent thing, that you can just subscribe to a limited list. So need not require every instrument, data for every instrument. So you can just say to the exchange that I only want this for data for this bucket. So they call it bucket data. So you only want it for say 50/50 stocks. So it will only send you for 50 stocks. That's it. So that way you can save on your bandwidth and you can make your system faster, right? So yeah. Right? It's a heavy consumption. Yeah, it's a heavy consumption, but given the technology is all managed, so it does not really contribute a lot to the latency. That's it. So next thing is the latency part. So latency is basically the delay that you have when you send an order or when you receive an information from the exchange. So it travels at some speed, right? It cannot travel faster than the speed of light. It will always be less than that, and there will be some time which it will take from coming from the exchange to you, and when you are sending it from your infrastructure to the exchange. Okay, so like you were saying that what will be the time, right? So time will depend totally on. So there are two kinds of latency. One would be the system latency, so which is this part, your own infrastructure. So that will depend on how fast your own network, and how fast your machines are, and how fast your programs are. For this part, for the system latency, it will depend on T1 or whether we have a T1 or whether we have a broadcast line, because decrypting broadcast will be simpler and less time consuming as compared to a T1. So that would be the difference. But the second part is the latency, which is the outside world latency basically. So that is the time that the data is taking to travel from the exchange to where your server is. Right. So say for example, if you the exchange is in BKC and their servers are in Ghatkopar or wherever. Okay. So it has to travel to Goregaon. So it will typically take 2 to 3 milliseconds, maybe 4 milliseconds, right, for that data to travel. If you are based out of say Kolkata, so you will have somewhere around 50 to 60 milliseconds that will take. If you are say based out of, not allowed in India, but say if you are based out of say Singapore, so it will be around again 90, 100 milliseconds. If you are based out of US, 120, 150 milliseconds. So it is basically the time which it is taking to travel. Okay. So now you can have this thing. How can you manage this thing? This latency, outside world latency. The only way to manage is you place your server as close to the exchange as possible. So that is what exchange gives you offering, which is co-location. So in co-location, you can place your server on the exchange's own network. Okay, so all the leading exchanges in India, NSE, BSE, every exchange provides co-location. So they will provide you a rack or half rack, and you can put your server in that, and it will be on the exchange's own network. So your latency would be like reduced to even less than a millisecond, because it's on the same network, right? So that is the only way how you can conquer this part. Second part is the system part. So the system part, there are different things which will affect your latency. One would be your network. So how clean your network is. If you have a very clean network, it will be faster. So that will help. Second thing is how much time you're taking here, how much time you're taking here, how much time you're taking here. So converting that data, market data, to your own language, your program, your strategy which it is running. So how much time is that taking, and order. So how much time is that order adapter is taking. So typically a good system would have a decently good system should have 100 to 200 microseconds for system latency. A very normal system would have probably 1 to 2 milliseconds in system latency. Now this part, what I'm saying is, when I say system latency, this is the part where market data hits your network to the time order leaves your network. So that is the time that we are talking about. So earlier it used to be like in tens of milliseconds. Then with the advent of technology, you had it like in single digit milliseconds. Now 100 to 200 microseconds. And then if you do further tweaks in it, and if you further optimize it, you can bring it down to 15 microseconds. Second thing can be, if you want to say get rid of the software part completely, and you can now there's a new thing like FPGA, right? So in which you program your whole thing into the chip itself. Okay, so there's no operating system, there's nothing, no software as such. So you program it in the hardware, and that brings down your latency to say 10 to 20 microseconds. Okay, and the fastest claimed one is like DB system. So a few months back they released a report in which they said that they are at 2.5 to 3 microseconds. There can be systems which are even faster than this, but they do not acknowledge that in public. So you can program the chip. So you have typically have an interface, FPGA interface, on which you can program the chip itself. But obviously that will require a very different kind of skill set. But that is, people do that. Not very popular in India right now, but it will become popular very soon, I'm sure. But yeah, extensively used in the developed market.
Is there any kind of backup software?
Backup. Okay. So now, see, there are two things. One is a backup. So you can have one is for the backup of the log, which you need for as per the exchange own compliance. You need to keep backup of last 5 years, all the orders, all the trades, whatever has happened. So you can have a drop copy while it is sending, or you can have it in the same server here itself.
No, I'm talking about the downtime. Suppose any downtime in between this all systems. So do we have any kind of backup, like from where we can alternate?
Oh, okay. You're saying that in case some links go down or something. Oh, that totally depends on you, how you want to structure it. It's not compulsory. But like here also you're mentioning B1, B2. You also have lines in which, like in B1, you will have a backup line as well on the same line itself. So if one goes down, you can have another one. Then you can switch your lines in between. If one line is going down, you can switch to another one. Then you can have your locations in multiple places. So you can have it in co-location. You can also have it in some other data center and your own location. So that's more of a BCP thing. So business continuity plan that you will have, that you want to keep your backup. How rigorous you want your backup to be, right? And you can have have mirror servers.
I don't know how people are trading. They must be having
There are all kind of things. So you will have people who are like who are very stringent on backup side. So they have servers, extra servers, which are mirror copies of the main production server. So in case something goes bad here, it automatically switches to this server. Okay. So that can be done, and that is done by a lot of people. Yeah, so that's the risk management part. So we'll come to that. So that's because you have to ensure. So there are two ways to look at it. First, one is from the regulator perspective. So regulator also ensures to the limit it can that you do not go into things which can impact the market or impact yourself as well. Yes, we have seen that happening. So in that case, exchange disconnected. So we saw one scenario in which what happened was that you had this virus or the Trojan which attacked the secured network of the client, but it did somehow. Sorry? That happens. That keeps on happening. That's more of a member-specific thing. So exchange member specific thing. So where you get those kind of viruses or malfunctions, then typically exchange will just disconnect. 1987. 97 the currency time.
Because of selling orders from Hong Kong. There were some.
In fact, not just that, you'll keep on hearing those kind of stories every few months. So some exchange or the other keeps on receiving those kind of bombardment of data, or in fact few weeks back also it happened, right? In which you keep on sending random orders, so you can impact a lot on the market as well as a lot of things which keeps on happening. So that is why regulator has this like SEBI has the prescribed norm. Algorithmic trading, in which it specifies that whatever strategy you build, you have to get it approved by the exchange. So if you're connecting to the exchange using algos, so you'll have to get the system environment, you have to get your risk management approved, and you'll have to get your strategy approved as well. So that you are not doing some kind of thing that can create havoc in the market, right? So that is the part that a regulator does. The second is on your own side, what you can do. What you will have to do is that you will have to ensure that there are proper risk limit checks are in place. So actually that's how the algorithmic trading system, the risk management algorithmic trading system, becomes very different from the risk management in the conventional trading strategy. Because say you have a team of 500 traders, okay, and they are trading manually, and say the exchange line goes down. Line goes down, the market data is not coming. Trader will create a havoc. That data is not coming, but they will not send an order. Right? Machine does not know that. You have to specifically tell machine that okay, if for this much time the market data is not coming, if it is not changing, that means there might be some issue. So do not send any order based on the competition that we'll be doing or based on this data. Right? You'll have to tell it specifically. Otherwise, it can send orders at 0 or whatever price. Then you'll have to ensure that again, regulators have also themselves done it very recently that they have banned market orders. So last from 29th-30th June, so they have banned the practice of sending market orders into the exchange. You will have to provide a price limit check. So where you can send like 10% away from the market, but you cannot send it the market order. Right. So this is a very 1 week old thing which happened. So you are recommended to have that kind of thing. So risk management has to be very, very given paramount importance if you're doing algo, because it will take probably a second or maybe less than that to just wipe out the whole firm. And we have seen firms getting wiped out, right? In the developed markets, even in India, on BSC, the Motor Trading, so in which the Sensex went from 17,500 to 15,000, 14,000 in no time. And then BSC actually cancelled all the trades for that day. So in F&O segment. So these kind of things do happen, and the quantity that was traded, I saw that it would have been like it might have gone into like hundreds of crores loss. Right. So that's something where risk management fails. So it does not take a lot of time. Similar cases, the flash crash in US. Very recently, the crash in Indian equities in the NFT, where the Nifty futures were traded till 5,000 while it was at 5,300. Then Infosys was traded 20% below. So typically, it is all blamed on algorithmic trading. To some extent, it might be true, but most of these cases happen because of some manual trade going bad. So especially in flash crash, what happened was that there was some huge manual orders, which was sent, and that just like instead of 2,500, it sent for 25 lakh or something happened for S&P, mini S&P contract, and that triggered a chain reaction. And then obviously there are all the stocks and everything is well interconnected. Right? There are a lot of pair trading, statistical arbitrage, index arbitrage, everything is going on. So if one thing is going down, then it will have an impact on the other thing. Right? So it happens, but typically there would be a manual reason for this more often than not. But yeah. Okay. So this part is good, right? So we got a basic hands on the technology and the network that is typically used and the algorithmic platform, right? Okay. Now let's go to the strategy. The strategy part. So for any strategy, what will be the typical parameters that you see if you want to build a strategy? So where will you start from?
Intraday reversal patterns, candlestick patterns.
So that. Okay. You said
intraday candlestick reversal patterns.
The kind of I can say
Technical patterns.
Technical or what?
Engulfing patterns.
Okay. So that's more of the kind of strategy that you want to build. Okay. Then risk appetite, based on my risk appetite, I will probably choose what kind of strategy I want to build. What else? So basically, what is the instrument that I want to trade into? Okay. Okay. And anything else?
Some event-related traders.
Okay. Okay. Mode of execution. Okay. You are saying basically that would be all technical or execution based or event related. Those would be different kind of strategies that you will have. So okay. Okay. Liquidity, early involvement, seasonality. Okay. So how I would say if I want to start building a strategy, what I will start from is that okay, what is the asset class that I will trade? I think that I'm already in equity itself. So NSE is the exchange that I want to trade into. Then I decide on what is the instrument that I want to trade. That would be, say, options. I have decided that I want to trade into options. Okay. Now, whether I want to trade or whether I want to execute. So that depends on whether I'm an institutional broker or I'm a trader myself. So that would be, if your execution, then it will be again what kind of executions that you want to, execution strategies that you want to do. If it is trading, then what kind of trading. If it is, say, let's assume if you want to trade. So if you want to trade, what would be the different kind of paradigms which are there? One is your arbitrage. So you are trying to milk inefficiency into the market. Always there. Then second is your the market making. These two would be typically the would be the things which are done in high frequency trading. This and statistical arbitrage. So when you are doing high frequency trading, these are the typical strategies that most of the people will be focusing upon. So what we mean by arbitrage is basically gaining out of the inefficiencies with put call parity is there. So if there is a situation in which the prices move in such a manner that you can actually make up an arbitrage using just doing the conversion reversal. So that would be an arbitrage or the cash future or just doing BSC and smart order routing. Second thing is market making. In market making, what you are doing is that you are making market. So typically, you are trying to eat into a gap. So you buy at a price, you sell at a price, you send quotes on both the levels, right? And based on that, you are trying to eat into the bid-ask and you're trying to capture the movement. So you would be selling when it goes up, buying when it comes down, while holding inventory. Statistical arbitrage is more of while say you choose a pair, kind of pair trading. So where you feel that okay, Infosys and TCS are very well connected, and I would like to trade a pair out of them, right? So that would be statistical arbitrage. So typically how it goes is that you start with strategy ideation. Then you build a model for a quant strategy. Build model, backtest it, and then implement it. So that would be a typical process. So if I take an example of say you want to trade different asset classes, you are connected to different asset classes, and say if you want to make a pair out of suggest any pair which are intermarket, as in not from the same sector, not in the same Nifty and USD. Okay, that's my favorite. So Nifty and USD. So typically what you'll have is that okay, whenever Nifty is going up, you feel that okay, USD comes down. Now, so there is a visual correlation that you see in the price movement. So that first of all you'll have to check and confirm that actually this is happening. So what you will do is that there comes a statistic for your health. So typically for algorithmic trading, the three main things are statistics and econometrics, your programming, and the knowledge of the financial market. So these are the three main things. So how statistics come into the picture is that if you came up with this idea that you want to trade between USD INR and Nifty, you will first have to show that or demonstrate that they are interrelated. So how will you do that? So you can either do a simple correlation that okay, this is a and you based on that you say that there is a correlation between both these things. Second thing is correlation is an old school thought. A more contemporary thing can be you go for a co-integration, you do some ADF tests, and you establish that okay, these are interrelated. Once you have shown that it is interrelated, what you will do is that next thing is to build the model. So for building the model, you will have to create something with a pair. So you will need something which is like more or less constant with some noise, or is mean reverting, right? So what do we mean by mean reverting? Is mean that shall I assume that basic statistics everyone is comfortable with, right? So mean reverting is like you have mean and the prices are going around price going around that. So you have to reduce the noise, and then ultimately you will get something which you can trade at say, minus 2 sigma. You will buy when that index is coming to minus 2 sigma, and plus 2 sigma you are selling, or whatever some levels that you will create. So create a bracket in which you can trade. Right. So that would be that is again where you will do a lot of use a lot of statistical parameters, and you will do things in which you can create that model, that index kind of thing, which is mean reverting, in which you can trade. So you can use anything from starting from Excel to R, Excel, MATLAB. So you can also put your strategies into say other more reduced platforms like Metastock or the AMI broker. Lot of things, lot of softwares which are there, and on which you can build the model and you can then backtest it. So building the main thing in building the model is that if you are doing a pair trading strategy, how do you arrive at that ratio? So that is the most important thing. So you can either just take a ratio of the two, then you take a moving average of them, then you clean it out, then you take a difference, first order difference, second order difference, and that might be something which is more or less stable, and you can trade based on that, right? So whenever it is going away 2 times standard deviation or 3 times standard deviation, you are taking a buy position, you are taking a sell position, right? So that would be your typical mean reverting strategy. And once you have established that, then you will generate orders that, okay, this is a buy order, this is a sell order. For this quantity, I'll be buying. You can further say that, okay, if it is at 2 sigma, I would like to buy one. Minus 2 sigma, I'd like to buy one. If it goes to minus 3 sigma, I'd like to scale it up. So typically, a pair trading strategy would be very different from your pattern or your base single stock strategy in which you are trying to ride the trend, right? Because in a trend following strategy, will scale up when it goes up, right, in your favor. In a pair trading strategy, you will certainly scale up when it goes worse, right? So it becomes very important that when you're doing a pair trading strategy and you're scaling up when it is going against you, so you always have blanket stop loss kind of thing. So that if it crosses, the total loss is crossing this thing, I'll just square it off. So that is very important, because pairs will converge, but the pairs converging does not necessarily mean that you will be making a lot of money. It might happen that there was a lot of movement, it went till something like came back to zero, but by that time the whole prices have moved and your whole model might get invalidated. So that these are the typical things that we will take care of. So that's building a model, generate the trade, then you have to backtest it. Now, backtesting algorithmic trading strategy has to be slightly different as compared to backtesting the typical conventional strategy, because an algorithmic trading strategy will not have like the Sharpe ratio. A typical Sharpe ratio for algorithmic trading strategy or a market making strategy would be very high. The reason being that you'll be deploying a very small capital. That's a typical thing for most of the high frequency trading strategy. The capital deployed is very small, but you do a lot of churning. So you make small profits, which will add up to something, which will be substantial. But the capital that you'll be using will not be a lot. So looking at the Sharpe ratio might not give you the right kind of thing. You'll have to look at more coherent parameters in which it gives you a basic idea of how it is, what kind of performance your system is giving, how many trades are they doing, and when you're doing a lot of trades, it becomes important that you take care of the brokerage part as well, because your typical markets are more or less efficient. So your typical money that you'll be making would be maybe just the amount that brokerage is there, the brokerage and the cost. So your trading cost, infrastructure cost, and after that you will have to make some margin. So So that is so you have to consider all of those things if you're doing the high frequency trading. And then you have to go and implement it. So building model can or cannot involve a lot of coding or a lot of statistics. It depends on you where you want to build it. You can build it on, like I said, simply on Excel, or you can build on more sophisticated platforms. Yeah.
And also, which are the trading platforms which are feasible with Excel for this practicing?
Trading platform, see, Excel is something like, even in our code, we cover Excel. We tell you that how to build models on Excel, and then we tell you that never again use it.
No, I have to say that the feed which we are getting on the platform is supposed to convert to Excel.
That's what I'm saying, that you should not. Because, yeah, you should not. First thing is that Excel does not have that kind of processing power. Second thing is, if you are doing high frequency, you will be most likely dealing with the tick data. So even a single data file might not get into Excel. Because Excel is about, like, even the new formats have 2 lakh, 3 lakh rows, right? The data will be much more than that. So you cannot use it for all practical purposes. And if you still want to go and use it by hook or by crook, then it will always get hanged. Right? So it does not have that kind of computational power. So if you want to do the high frequency stuff, then you should probably use R or MATLAB typically. So they have much more computational power, and you can actually just leave your machine on. You can put that on server, and you can use the processing power of a server, and you can then keep on running for hours if you want. If you want to do it for like lots of years, right? Coding you will typically be doing in some algorithmic trading platform, right? So first thing is building the model. So that you can do anywhere. So you will not be doing it in the production, right? So you are just testing it. So that's fine. You can do it anywhere. You do not really care, because that will not impact on your money making, or that will not risk your whole thing. Right?
That's what I was thinking. That is in Excel. Suppose I need to backtest some strategies.
You can do that, yeah. You can do that. In fact, if you're doing it for like the daily strategy or not a high frequency trading strategy, then you can definitely use. And in fact, all of us use it. So Excel we do use, but if you want to go for more computationally stronger things, that would be better if you take your strategies to the next level. So that's the thing. And typically, in most of the algorithmic trading platforms, you code in C++. They also have adapters for C hash or Java, C. But C++ is the preferred language worldwide for algorithmic trading strategy. So that's the thing. I can go deeper into it with multi-threading, but I don't think that will go out of the scope. So yeah, C++ is typically where we code, and all different kind of they have all their inbuilt APIs, and which you can use directly for sending orders. You can use a piece of code which is already there. So that is there.
How long the duration do you look at when you backtest? Or does it depend on
depends on strategy. Yeah. Typically, if you are working on an intraday system which is generating few trades a day, then typically you should go for probably the 5 minutes or 10 minutes data.
So the duration is historical data. How long that?
The thoughts are divided on that. Even within our team, we have different thoughts on this. But to my own personal understanding, it's you should not go for a very long historical backtesting, because markets keep on changing. And given there are external impetus to the market in terms of the whole infrastructure issues, the whole technology being changed. So, like with the advent of algorithmic trading, the trend we used to see it has changed quite a bit in the past 2-3 years. Right, because there are a lot of noise which has come into the picture, and then if you're doing a strategy based on order book market microstructure, say, so in market microstructure based strategies, you have the whole order book dynamics has changed. You will not see any orders in it, and when you go and try to just clean the order book, you might just have to face like billions of them, right? So because earlier it was people who are sending orders. Right? So if you're really good, you can probably send an order in 1 second. If you are a Superman, you can probably send 2 or 3 orders a second, but not more than that. And machines can obviously send hundreds of them in a second. It's only limited by the exchange. Otherwise, you can even send tens of thousands of orders a second. But
what is the limitation from the exchange part?
I told you that release lines so you have 200, right? So you cannot send more than 200. If you are sending more than 200, they will be queued. So that will only happen after first 200, then in the next second. And if you just keep on sending them, then it will get buffered. So you will be living in past then. So yeah. So this is so now when we go to the implementation part, so now also in backtesting, what is the major obstacle that you will face is that whenever you're doing some market making strategy or any strategy in which you're quoting, so it is very difficult to backtest it. The reason being that if you're just sending market order, then you know that whenever this thing happened, I would have taken this price and this would have been my execution price. If you're doing market making or if you're sending an order in the market, so first thing is that your order itself has impacts the market, right? So that order will have someone might see and might hit you, but you cannot do that in simulated market. So you can only test it out in the real market. So how do you test that? So typically what people do is that you send a quote, and if it is say if the last hit price is like below that price, then you assume that okay, it could have got executed if it was a buy order. So another way of doing it is that you can, in the simulator itself, you can provide some artificial intelligence in which it will find out the probability of getting a fill at a particular price. Right? And based on that probability, it will compute a price on which it will decide whether you have got a fill on this or not. There are a lot of projects even in early 2000s, like Lehman sponsored project in I think one of the leading universities, in which they build these kind of simulators. So in which how to test out high frequency trading strategies. But I think it's a probabilistic thing which will happen. But that's the constraint that you'll always have in testing the coding strategy. So the thing is that you'll have to ultimately go into the market, maybe start small and see how it goes, how it behaves in the market itself. Also, if we are talking about quoting, like we said, USD INR versus Nifty. So if you are trading a pair, and if it's a if you're trying to do it on high frequency, so it'll be your profit margin will not be very huge. So how will you decide whether which one to be quoted and which one to be covered, right? So whenever I'm trying to execute a pair, I can either send a market order on both of the sides, or whatever I'm getting the price, getting the fill at in the market. So that will give me the surety of the fill, but I'll have to pay bid ask on both the sides, both the stocks. So if I want to say that I will keep on quoting on one side, just about the bid to buy, so that will at least reduce my bid ask on one side, one leg. So the thing becomes that which one should I do? So like in the current example, USD versus Nifty, what is impacting what? It can be because USD is going down, and the economic situation is getting worse, and therefore FIs are taking away money, and therefore the market is also falling down. Second thing can be markets are falling down, therefore FIs are taking out money, and therefore USD is coming down. Right? It becomes chicken egg story. Right? So typically, what you can have is that you can do some again statistical tests. So you can do some probability test, and you can say that to this extent, and I can say that up to this probability interval, the confidence interval, this is what is causing the impact in the other side. So once you know which one is leading, so then you can always send orders in the asset class in the pair leg which is leading, so that you will get less slippage, less amount of slippage. Sorry? So that's what the causality test is for, right? So say if you are doing some transit causality test. Hmm? It can be, but that's what it's better than shooting in the dark, right? But you will have to, because obviously even when you do a statistical test, you only get a confidence interval that you can say that okay, at this confidence interval I can say that this might happen, right? If you are flipping a coin, if you're talking a coin, then it's 50% it can come heads, it can come tails, right? Tails, tails. But that doesn't mean that if it was head this time, it will come tails next time, right? But there's a probability. So that's what you do. So you will be better off if you put your money while flipping a coin based on the thing that okay, if, it's coming head, then the probability is 50%. Random walk theory. Random walk theory. Yeah. That is it. Okay. So anything on this? Yeah. Cool. Let's see. So what have we all covered? Okay. What next in this? I think we have covered the basic concept, background, India versus developed market. India versus developed markets, it's catching up pretty fast. So we had like in US on different exchanges, it's a different statistic, but still in NYSE it's more than 75-80% of the volume is through algo. In LME, London Mercantile Exchange, it will be metal exchange, it will be more than 50% or 60% which are through algo. In India, typical number would be 20, 23-25% of the total volume. But in fact, there was a report in Business Standard a few days back which claimed 40%. I don't know the sanctity of the report, but that was there. So it's catching up pretty fast. In developed markets, it was like decades back when algorithmic trading started. In India, 2008 it started. 2008 to 2009, there was hardly any action because of recession. Nobody was willing to put in a lot of money into new kind of things. But since 2009, it picked up, and in past 3 years, it has already, even if it is 25%, that's considerable volume. So, but given that we are just replicating the developed market in terms of volume participation, it is bound to increase with time. So overall, even the infrastructure side, the things have changed. Like earlier, what we used to have was, if I just go through a timeline, in April 2003 or 2008, SEBI allowed algorithmic trading and use of DSS as decision support system. So SEBI allowed algorithmic trading. Then after some time, they started NSE started their own co-location services. So that was sometime in 2009. First on they provided just a full rack. So a full rack would be, but typically it's 42 units. So 42 units means you can have if you have 1 unit server, you can have up to 42 units, 42 servers in that rack. You will need some space for other things, but that's a 42 unit space is what NSE started with. Then they started providing half rack. So for this they used to charge about 30 lakhs at that, 35 lakhs at that time, 35 lakhs per annum. Then they after a human cry that okay, smaller brokers are getting killed, so they launched half rack, which has 21 units. They offered this at around 16, 17, 18 lakhs. Then after some time they revised the prices. Then this was brought down to 21, 22 lakhs. This was brought down to 8 to 10 lakhs. So this is basically to promote algorithmic trading even for smaller players. But SEBI and it seems that SEBI and exchanges have been very clear in the thing that they want to move very cautiously. So that's why they started with high end, so that only the people who have the good adequate technology as well as the adequate human resources to manage this, they only come into this, because otherwise it can become really dangerous. So that's why even now retail is not allowed to do algorithmic trading. It's only allowed for institutions and the members of the exchange. Right. Then NSE started providing tick by tick data. That was again in 2010. So before that, only broadcast data was there. So this is something which is really important to a lot of people who are totally into quant-based strategy. So getting this thing actually changed the overall thing. Then they started with smart auto routing was allowed. So you can automatically choose between whether you want to hit your order into BSC or NSE. So wherever you're getting a better price, you can send an order. Right. Then they also came up with, there are a lot of other initiatives as well which were taken. So which was to promote algorithmic trading, but you will see that all of them were taken stepwise. So it's not like that they are not going full-fledged. And also exchanges typically also need some time to adapt themselves to the technology. So the developed markets exchanges do have much better technology probably. But in Indian exchanges also it has been improving. So that's why earlier there was no concept of 200 message lines. So they started 200 messages line as well. So because they got their technology infrastructure upgraded, they can offer you better services as well. So that is there. And like just to talk about the current affairs as such, like last week again there was this penalty which was given. Worldwide exchanges provide penalty for auto trade ratio. So if a very high auto trade ratio, that means that you are clogging the exchange server just by sending a lot of orders but not trading anything. So which is perceived not to be good for the market. So they provided penalty, but again they kept a thing that they said that if the orders are sent within the 1% of the last trade price, in that case that is not applicable. So that again means that the exchange is willing to take action against people who are sending orders just at random prices, much below, to take advantage of if some algorithm fails or if some crash kind of thing happens that you want to buy that and you keep on replacing that. So you are cheating on the exchange's bandwidth. But if you're sending genuine orders, the exchange does not want to penalize you again. So that's the thing. So I think it's different for like is the range about 20 there is a penalty of 1 cash per order, or about 50, 20 to 50 this is the range. I don't know the exact numbers, but yeah. Even in the exchanges abroad you have similar kind of measures that exchanges take. Yeah, last week only the same. Before that also it was there, but they have further modified. So yeah. So that's the typical how algorithmic trading has been coming up in India. So a lot of even news-based strategy like someone was mentioning. So a lot of people have started on that as well. Now you have since last year you have news-based analytical software which you can use for algorithmic trading in available in India as well. So I just provided it to the extent of my knowledge. I think Dow Jones also provides it. So what it does is typically you'll have two different kinds of news-based analytical systems. One would be your economic data base. Say you have algorithms in which you want to do inflation expected to come at 8.5%, and if it is coming at 10%, you have a strategy which you would like to reverse. That okay, I would like to buy this much, or I want to sell whatever you want to. If it is coming at 11%, I want to do this. If it is coming at 10.5%, I want to do this. So all of that you can fetch, and whenever the data comes in, it is automatically read by the machine. It need not provide it, and instantly it will trigger your orders. So that is one thing. That's economic database event-based trigger. Second thing can be completely news-based algo. Then in that what happens is that you have news which is coming in machine readable format. So say Dr. D. Subbarao says that he feels that economy is going through this phase, and there's a choice of words which he is using, right? So you can have a algorithm which provides a score to a news story that okay, if these are the words that are being used, then probably I would score it at 90, 51. So there are ready-made tools available for this. Comes at a high cost obviously, but still they are available, or you can build your own. But it involves a good amount of NLP, natural language processing programming, and it's difficult, slightly difficult with like English being a funny language. We say it can be awful, can be really good, or it can be really bad. Right? Awfully good moment or awfully bad data. Right? So it can be either way. So you have to program your machine very carefully while reading it. So that's also active. So people are using that as well. So that is also happening. And the further new things on the technology side as well as on the analytical side, which are under the process, and probably take the volumes to the next level.